What's up, gang? Welcome to The Greatness Machine. I'm your host, Darius and Mohnish. I'm so pumped to have you here with me. Now listen, The Greatness Machine, we're about two things. Number one, people who are living their passions. And number two, those who are creating greatness in the world and doing both of these things despite the odds against them. Each episode, we're going to feature interviews with game changers, business leaders, telling us their origin stories, what made them tick, what got them to where they are now. Why? So it can help you step into your greatness within your life, your business, and your career. Occasionally, you might hear a few solo episodes from myself, moi, as I say, as I leverage my 20 years of entrepreneurship as a CEO and founder to help you grow and level up in your journey to scale your life and your business. So, come be a fly on the wall, enjoy the conversation, and I'm stoked to have you here with me. Welcome, everybody, to today's episode of The Greatness Machine. I'm your host, Darius and Mohnish, and boy, do we have a special guest. Mohnish Pabrai is in the house. What's up, Mohnish?
Doing good. How's it going, Darius?
Oh, man. I am so pumped to have you here. I came upon your work about, I guess, 2.5, 3 years ago. I was reading our mutual friend of ours, much better friend of yours than mine, but two-time guest on The Greatness Machine, William Green. Read his book, Richer, Wiser, Happier, and was really enthralled by your story. First of all, I love his work. I think William does an amazing job of talking about what's important in life. But saw your work and was like, oh man, and then saw you're in Austin, which obviously everyone knows I'm in Austin, and I'm like, oh man, I want to interview Mohnish. So grateful to have you here, my friend. Thank you for coming on the show today.
Well, likewise. Good to be here.
Definitely. So for those listeners, you guys know that I'm a selfish human being and I like to selfishly bring the folks on the show that I want to learn from. But for those of you that are not necessarily familiar with Mohnish's work, he's a businessman, investor, and philanthropist, founder of multiple things, founder and chairman of the Dakshana Foundation, which we'll be talking about a little bit on the show, as well as founding and managing partner of Pabrai Investment Funds. He's a value investor, so he's a big fan of our friends over at Berkshire Hathaway, Charlie and Warren Buffett, and founder of multiple other high-tech businesses. So I'd love to, here at The Greatness Machine, Mohnish, we love origin stories. That's one of the things that we really cherish is learning, like, how did people get to where they got to? Obviously, you didn't wake up one day and just were a value investor the day you were born, creating value in the world in the way in which you have. How did you get to where you got to? Would love to hear some of your origin story.
Well, I think the origin story for me and probably a lot of entrepreneurs is very similar. I think us entrepreneurs look for what I would call offering gaps, and the world has a lot of offering gaps, and when we see an offering gap, some of us, if we have some skills that can maybe help address it, then we'll go for it. So, for example, Howard Schultz at Starbucks saw a big offering gap, or Italian-style cafes selling high-priced coffee in the U.S., and the wide open market, and went through it. So, whenever we see things not being offered that we think ought to be offered, I think that's where a lot of entrepreneurs step in. And sometimes they're right that there is indeed a gap, and they have the skills to address it. And sometimes they're wrong, and they can go back to square one and start over. And so in my case, I had my degrees are in computer engineering, and I was working for a kind of high-speed data networking firm as an R&D engineer, and I always had an interest in kind of doing something on my own, and the first startup idea I came up with a couple other guys, I think maybe $5,000 got spent on it, and maybe about 2-3 months of work, and went nowhere and died. And the second idea also basically not much money, but a few months of work, and again died. And the third idea I had, which was when I was 24 years old, basically was something I pursued myself. There wasn't a team at that time, just myself, and it took off. And so I hit a rich vein of a offering gap. I had an idea of what I wanted to pursue, but the reality with these kind of early stage startup businesses is that whatever idea you come up with in your ivory tower is going to be wrong. It's not going to be what people want. And just to give you an example, I was going to be providing some relatively new IT services, system integration type offering. And I remember this was before I had even quit my job. I used to take half a day vacation day whenever I had a meeting with a potential client. And I was meeting with the top IT guy at a large bank in Chicago. And I was running through my deck, and the CIO said, go back to slide 10. So I went back to slide 10, again, talked about what I had talked about, and went to slide 11. He said, go back to slide 10. So again, went back to slide 10, again said what I wanted to, and then I went back to 11. He said, go to slide 10 and do not change the slide from slide 10 for the rest of this meeting. Okay. And I said, okay. And basically what slide 10 was talking about, it was talking about a new paradigm in computing. Client server computing was just coming out in the early 90s. And it was a severe pain point for him. And so usually when you start a business, like I said, you don't know what the market wants. But if you listen carefully, your customers will tell you what they want. So what I did after that meeting is I went back, I made slide 10 into 30 slides. I expanded slide 10 into 30 slides, and I threw away everything else. Okay. So it was honed in on exactly what he was asking for. And then when I went to the next meeting, it was a cakewalk because the exact same pain point, and now the deck was on point. So what I've learned repeatedly in my business ventures is that you have to listen carefully, and it's not easy because we have ideas in our head, we're headstrong about the ideas, we're passionate about ideas. I had to throw away crown jewels that I cared about.
Yeah.
And I had to hone in on what this guy was actually, because when I thought about his pain point, I realized why it was a pain point, and I realized why there was an offering gap. I said, no, the offering gap is not what you thought, Mohnish. It is what he is showing, because nobody offers that. And so when I switched that, we in about 9 months, I was both running my business and doing my job at the same time. I had no money. And so I used to wake up at like 6 in the morning, work for 2, 3 hours on my business. Then I'd go to work. And then again from like 6 in the evening till midnight, and then weekends. And I did this about 9 months, and it was really intense. And after 9 months, I had 3 clients.
Nice.
And these 3 clients were generating enough cash flow that was higher than my salary. So I was dying to quit. And so I went in and I told my job, hey, my boss and his boss that, hey, I'm resigning. I've started a business. It's not competitive with you guys, so it's all cool and whatever. And one of the things I had done is that before I started my business, I used to be a top performer at work. I was all in, and I'd get great reviews. But once I had started this company, I said, Mohnish, the focus is the company, not the job. So all we need to do in the job is be just above firing level. So all I'm going to do in the job is I'm going to give enough so they don't fire me because I need someone to pay the rent. So when I resigned, my boss and his boss say, for about 9 months, we were really confused because suddenly we saw that something changed, like a switch went off. And the old Mohnish was not there. And there was a guy who was just kind of very mediocre. And I said, yeah, exactly, because I was working on my business. And I said, I was trying to keep it just above firing level. He said, we had this discussion where we said, he's not so bad that we want to let him go. But something's off. And they said, now we know. And so I said, that was exactly my point. I wanted to be right at the point
Right
where
there.
you guys would have the discussion, but wouldn't let me go because I needed you guys. And so, one of the things that's a very common trait with a lot of your guests, I'm sure, is focus. I mean, the most important thing is focus, right? And in mathematics, they tell you cannot optimize for two variables. In any math equation, you can only optimize for one variable. And that's the same thing when you're starting a business. So I have never been able to go all in on two things. It's just doesn't. If you try to go all in on two things, you're going to be bad at both.
Right.
It's just not going to work. So you have to find out what makes you tick, what you're passionate about, and then you just got to go all in on that.
Yeah.
And I was all in for 9 months. The business was just embryonic enough to get going, and I was dying to go full time because I said, if I can do 80 hours on just the business, I can just blow the doors off,
Right.
And, the first year after I quit, we did about 500,000 in sales. The second year was 1.4 million. The third year was 2.3 million. And then 3.5. So it was very fast growth. And these were years when the US economy was in a recession. So there wasn't like a tailwind coming from the economy, but because we had the offering gap and because I was all in, it was just, you were riding a rocket ship, which was great.
Yeah. I love that. So you, when did you sell, you sold that company? It was in 2000. Is that correct?
Yeah, that's correct.
And how big was the company when you exited?
It was about 20 million in revenue at the time.
Wow. And you were under 30 at that point, or were you just right around 30 years old?
No, I was, in 2000, I was 35.
Oh, got it. Sorry. I thought you were 24 when you started it.
Yeah, I started in my 24, 25, and about 10 years later.
That's
the
amazing.
business got formed in 1990.
Oh, okay. Got it.
And then it got sold in 2000.
And so, that's, and that was not your first entrepreneurial attempt. That was just your first success. Is that correct?
Yeah, I mean, I had two previous attempts, but so the thing, this is the thing about entrepreneurship. There is a very huge asymmetry, and we can take advantage of the asymmetry. So basically, I knew that any venture I start, because I had no money, it could not take money. I mean, you don't have money, where is it going to come from, right?
Right.
So if I have a job and I keep trying different things, which are low capital intensity, and all these tech businesses are low capital intensity. And now they're even more lower capital intensity because it's all brain power. And so basically you have the ability to do 30 times if you want to.
Right.
So you can do it once, it doesn't work, go back, do it second time, doesn't work, go third time, fourth time, fifth time. You can keep doing this. And each time you do this, you're going to learn a lot, right? And so you're going to fix things that you didn't know that you know now. And at some point, you're going to hit the mother lode. And that's it. You basically could have a 2% success rate. You could have 50 tries, but you'd only need to hit the mother lode once.
Yeah, it's funny. Like as you were telling your story, I was thinking of my own entrepreneurial experience. I was at UT, I don't know, 18 months ago, no, almost 2 years ago, and I did a talk to a bunch of like juniors in college about entrepreneurism, and I was like, how should I start this talk? And I was like, I should tell them about all the businesses. I should like, figure out how many businesses I started and how many I would consider a success. And I had two variables involved with that. One was it had to make $1 of revenue to be an actual business, and it had to have $1 of profit to be a success. And then I had a third variable, which was what was something I was like happy I did, because there's plenty of businesses I started that were profitable that I regretted because it was a big time suck. And the numbers I came down to was I had started at that point 24 companies, 9 of which made a profit, 6 of which I actually was happy I started. And so
That's a good hit rate.
not bad, right? And by the way, my hit rate's gotten a lot better over the last couple of years, as I've been doing this for 28 years. But it was funny that I looked at the beginning part of my life, and there was like I was like kind of like when you were describing your start. I'm like, oh, this sounds exactly like mine. Working 100 hours a week and like side hustling to test ideas. I love that, man. How did like when you exited the company? How did you feel? Like obviously you had some liquidity probably for the first time. What changed for
Yeah,
you
so
then?
actually what happened in 99 is really after 94, 95, after 4 or 5 years, the company was growing a lot. It was growing very rapidly. And when I sold it, it had 170 people.
Nice.
And when I started, it was just me. And I truly loved the business when it was less than 10 or 15 people.
Yep.
And what I found is that as the business got bigger, I was spending all my time in HR. I was herding cats. Okay.
Yeah.
I am not a cat herder. Okay. And I was in pain. I was in severe pain. And in 94, 95, I'd heard about Warren Buffett for the first time. And I had started to go down that rabbit hole. And I found that rabbit hole incredibly exciting. And in fact, so there's the company where I'm losing interest, but it's still growing. And people who work for me think I'm excited about it. I can't fake it. It's really difficult. And then the investing side, which I was getting more and more interested in, was drawing me in. And so one of the big aha moments I had when I heard about Buffett for the first time and I read about him was that when you start any business, you will spend maybe 2, 3, 4% of your time figuring out a strategy and direction. And then 96, 98% of time is all the blocking and tackling to make it happen. And I enjoyed the blocking and tackling to some extent, but I truly really enjoyed setting the direction and figuring out the models.
Yeah.
Like when that guy told me stay on slide 10, going back and redoing the deck and redoing the whole strategy, that was where my sweet spot was, right? Executing that had to happen, but it was not as exciting to me. So when I heard about Buffett making all these passive investments, when you make an investment, you're using the same part of your brain that you would use when you're trying to figure out a new startup. They both use the same brain cells, except what he was doing is he was not doing the blocking and tackling. He would find an investment, some company that's already running like Coke or Gillette or whatever, and he'd just back it and he'd be passive. And I said, that's where I want to be. I want to make the 3% 80% because that would make me happy because I really enjoyed the 3%. So what I started doing is in 94, 3 or 4 years after we started, there was a sale of a small part of the business. Some guys wanted to buy a piece of the business, and I had sold the business after taxes, everything. I got $1 million at that time, And I didn't need the million because the business was profitable and all of that. So at first time I had cash in my account. It was the first time I had money. And I was getting interested in investing. I said, I'm going to take this million and I'm going to start investing it the way Buffett invested. And I want to see what happens. I want to see how well I can do with this while I'm, running the IT company. So basically, I started spending 10, 15 hours a week on investments, and I was still going, 40, 50 hours a week working on my business, which I was losing interest in. That million in the next 5 years became about 13 million.
Wow.
I compounded at like more than 70% a year.
Wow.
And there were years when me alone working 10 hours or 15 hours a week was making more money than the business with 70 people. So I'm enjoying this, and I'm a HR cat herder over on the other side. And so we finally get to 99, and I have, I'm financially independent now, right?
Yeah.
Even if the business went away, I have financial independence just from the passive investments I've done. So I really had a soul searching at that point. I said, what am I doing? And why am I spending time? And I had gone through this 360 psychological analysis with two industrial psychologists at 99. And they had given me a bunch of tests. They had interviewed all the people around me, my friends, employees, spouse, etc. And they eventually gave me what I call my owner's manual. And they told me, Mohnish, we don't even know how you get up and go to work because it's so far away from who you are. They said that you are a guy who likes to play games. You like to play math games, but you like to play math games where you have the edge to win. You don't like to play multiplayer games. You like to play single player games. They said the company you're running, there's no game there. You're just managing HR, which is a whole big team. So he said, you're not the kind of guy who can be a guy on a soccer team and be happy because you would not be able to drive outcome. You could be a striker or a goalie or whatever, but you wouldn't be able to drive outcome. The team drives the outcome. So the nature of who you are is to play games where the whole outcome depends on you, nobody else. So at that time, I had identified another offering gap, which was a really big offering gap. And that was the Buffett partnerships, which had ended in 1969. And I had realized that those partnerships had been very successful, and it had been 30 years since they ended. Nobody had replicated that model. And to me, that was classically a wide open opportunity that there should be more funds following that model because of the most successful hedge fund ever run. And there was nobody doing it. So I said, wow, that's a huge, you can drive an 18-wheeler through this offering gap. It's just huge. And when these like psychologists understood what I was going to try to do next, they said, this is so right on. This is you. You will be incredibly successful. And one of them, so Pabrai Fund started in 99 following that model. One of them, we started with $1 million from 8 investors. One of them gave me 100,000. So I told him, listen, man, you did all this testing and all that. I gave you $2,000. I don't want to take your money. If I lose your money, I'd feel really bad about it because, you guys work for a living and all that. So the guy said, Mohnish, I split your brain open. I saw what's inside. I have no concerns. Please take my money. Okay. And he did extremely well with that 100,000. He did extremely well. And it's now been like 26 years, 26 years, yeah, since I started. And I haven't gotten bored because it's still a single player game. And what I understood was We ain't building a fucking team. Excuse my French.
No, it's all
Okay?
good.
We're not building a team. We're not building a soccer team here. We're not going to be a forward on a soccer team. That's not who I am. We're going to play chess, single player game, and we're going to always play chess and keep it that way. And it worked.
I love that, man. There's so much there. One question just for the audience, that because our audience is a mixed audience. When you say the 18-foot wide like opportunity gap with Buffett partners, are you talking about replicating a value investing model? Just explain.
So what Buffett did, he ran an investment partnership from 1956 to 1969, 13 years. In those 13 years, he compounded before fees at low 30% a year, like 33, 34% a year, really high. After
Wow.
fees, it was high 20s a year. And he started with $100,000 and he put in $100. So his own money in the funds in 1956 was $100. When he ended the partnerships in 1969, he had 100 million under management. And he had set up a very unusual fee structure. That fee structure is what I was very attracted to, because that fee structure created a huge competitive advantage. So what he told his partners is that normally hedge funds and private equity funds charge a 1 and 20 or 2 and 20 type structure. They take a 1 or 2% management fee every year and then 20% of the upside.
Right.
He told his partners the deal is it's 0.625, which means there's no management fee. The first 6% returns every year go to you, the partners. After that, whatever we make is 1/4, 3/4. So, for example, if the fund was up 10%, you would get 6%. The remaining 4%, Buffett would take 1%, and you'd get 3. So it'd be 9 to the investor, 1 to Buffett. If he was up 20%, he would get 3.5%,
Right.
because you'd take 1/4 or 14% and so on. No one is willing to do that because it is a high risk proposition, in the sense that you would effectively be running a business where there's no guaranteed revenue in a given year.
Right.
If you are down 10%, the fee is 0. And you've got rent and office and people and all that. So how are you going to pay that, right?
Right.
And he also had high watermarks, which means if he was down 10% one year,
It'll make you up.
second year he'd have to come to baseline and then 6% beyond that.
Right.
And so when I looked at that model, it was a very successful model and it was a win-win for everyone, right? I mean, there was no losers in that model. And I said that this is the way the investment business should be,
Yeah.
because it should be a win-win for everyone, not heads I win, tails you lose, which is the way the current models are. And I also felt that if I set up a fund with that model, with the 0.625 structure, I'd be the only fund like that. And if you're the only fund like that, you have now created a monopoly. Monopolies are beautiful. So I said, I can do this because I don't need the fees from the fund to pay my bills. I don't need it. And
Yep.
I was running the fund out of my home. When I started, there was no office, there was no people. So the expenses of running the fund were like $10,000 a year or $20,000 a year. It was nothing. It was irrelevant, right? So I started Pabrai Funds with $1 million from 8 investors, okay? And for the first 8 years that we ran, we had no down years. And we compounded at 36% a year before fees.
Wow.
Well done, Mohnish.
Good
Well
job.
done. Okay. And there was an avalanche of fees because the assets went from 1 million to 600 million.
Oh, wow.
And I was running a business where revenue is equal to net income.
Right, because there's no overhead.
Try to process that.
Yeah,
Okay.
yeah.
Even Apple doesn't have a business where revenue is equal to net income. It runs a really good business. Even Google doesn't have that business for revenue. So I was running a business where sometimes the fees would be 25 million in a year.
Wow.
Okay. And the expenses, if I exclude my salary, 100,000, 200,000. Okay. And I said, hallelujah. This is so basically, it was exactly, so the thing is, when we started this conversation with the concept of offering gaps, right? And later, I became friends with Warren and Charlie. And I was having a conversation with Charlie a few years back, and right, like maybe a year after we met, and I explained to him how I had looked at the Buffett partnerships and I couldn't find anyone who was doing that. I said, Charlie, from 1969 till 1999, nobody that I could find took that model that was sitting on a shelf. Anyone could take it. Okay, no one took it. And from 1999 till now, that's like another like 26 years, nobody's taken it still. Even today, I run the funds with this model. I don't have competition because nobody wants to go down this path. And so that's fine. Leave the offering gap forever. Normally, what happens in capitalism is offering gaps close. So if Ray Kroc identifies McDonald's as a great model and he gets going, after some time, Burger King's going to start, Jack in the Box is going to start, Arby's is going to start, and a zillion other people are going to start. And eventually that space is going to become more crowded.
Right.
That's the nature of capitalism, is eventually most offering gaps close. Now, McDonald's has survived because they built a brand. But basically, the nature of capitalism is you identify an offering gap, you can make some money for some time, and eventually that gap will close. Once in a while, you get these enduring businesses where that gap stays. Like, for example, if you look at Google currently, Google identified a great offering gap with the way search was being done versus what they plan to do it, right? But now we have this AI threat,
Right.
and they're really scared
Yeah, they should be.
because they can blow it. Now, they also have the wherewithal to ride the curve and transcend it. We will find out in the next 5 or 10 years whether Google was able to jump from one curve to the next. More than likely, they'll be able to jump.
Sure.
But there's a good chance they may not be able to jump. Some kid in a garage might blow them out, And so that's the nature of capitalism. And so when we get offering gaps that stay for these long periods, that's extremely rare.
Yeah, I agree. I have a question for you. But by the way, this is fascinating. I really appreciate like the long-termism, the perspective of putting skin in the game. I've always been someone that's not afraid to bet on myself, even to the point where it's looks foolish, but to your point, outsized risk, outsized return. And it sounds like it worked out for you pretty well. When you start looking at the nature of, and I'm assuming the model was value investing, which was that's the Charlie Munger, Ben Graham, Warren Buffett model. When you start looking at today's markets, and you start looking at the opportunity set that's out there, given A, the number of players, B, the number of opportunities, and C, I guess, the efficiency or quote unquote inefficiency of markets, depending on your belief there. What are your thoughts regarding alternative investing with that same model, or looking at, let's say, private companies versus public markets and leveraging the same model that you use to create success in the public markets?
Yeah, so I don't have much interest in private businesses. And the reason I don't have much interest in private businesses is because when I work in the public markets, there are no negotiated transactions. It's an auction-driven market. So in in a in a private market, let's say there's a home for sale. Okay. There's an intelligent buyer facing an intelligent seller. And that home is going to sell most of the time at fair market value. It's not like you can pick up a home which is for 300,000 for 30,000. Those types of things would be something weird has to be going on, but that's almost unheard of. But in the public markets, because they are auction driven, you can get some very wide swings. Companies can get highly overvalued and they can get highly undervalued. So, there are 50,000 stocks around the world. In a given year or 2 years, if I can find one or two stocks to buy, I'm doing extremely well. So, sometimes people would come to me and say, I remember a few years back, I was in my gym, and some guy comes and say, "Hey, what do you think about Apple?" Okay. And I asked him a question. I said, "What's the market cap of Apple?" And he said, "What?" I said, "What's the market cap of Apple?" He said, "Oh, well, the stock's at $35. I said, "No, I didn't ask you the stock price. I asked you, how much can you buy the whole company for?" And he didn't know. Okay, so I told him, okay, let's say, and let's take this as a real case. Let's say the market cap of Apple is 3 trillion, which is approximately where it is currently. But let's say it's 3 trillion. And let's say I have a family fortune, which is 10 trillion. Would I be willing to put 30% of that family fortune and buy all of Apple? And so the question to ask is, if someone said you can buy Apple for 3 trillion, well, the question I would ask is, how much money does Apple make? Right?
Right.
And I don't want something that makes 200 billion being bought for 3 trillion. It'll take me forever to get my 3 trillion back.
Yeah.
I want to buy it for 3 trillion if it's making $1 trillion a year, growing at 10-20% a year. Tell me. And so, does Apple make $1 trillion a year? No. Okay. Does NVIDIA make $1 trillion a year? No. Okay. So we are not interested. So the first rule is we have no interest in any stocks that are mentioned anywhere in any media or any place, mainstream, the Mag 7, whatever. We have no interest in any of that. Zero. We are interested in what I would call anomalies. So 7 years ago, I made my first trip to Turkey, Istanbul. And the reason I went to Istanbul is because of two reasons. One is the Turkish market was screening extremely cheap, the cheapest market in the world. And I had a friend there, good friend, who was running a fund in Turkey. He's a deep, diehard Ben Graham disciple. And I told him, I said, look, I'd like to visit Istanbul and I'd like to meet the businesses in your portfolio, if that's okay with you, starting with the one where you have the most money invested and then ending with the one where you have the least money invested. I said, don't take me to any businesses where you don't have your fund invested. So he said, Mohnish, this will be a blast. Come on over. Let's go. Okay. And on my second visit to Turkey, so when I would visit these companies that he was taking me to, I did no work on these companies before I visited them because I didn't want to waste my time. I wanted to get some base level understanding and see if there's some meat on the bone. Then I would spend time on it. So usually when we were driving to a company to meet them, I'd start asking him questions about the company, just so that I'm not total idiot at the meetings. So we are driving to this company, which I've never heard of, company called Resas. I said, so what's the situation? Why you invested? He said, Mohnish, the market cap is $16 million, 1/6, and liquidation value is 800 million. Okay. And I said, is it a fraud? He said, no, it's not a fraud. I own it. And he said, it's a very simple business. They rent warehouses, and they rent warehouses to Amazon, IKEA, Carrefour, Toyota, Mercedes. And he said, look, they own 55 warehouses around Turkey, huge warehouses, and they're 99% leased, inflation indexed leases. And he says, you can go to any real estate broker, show the portfolio, and they would tell you this is worth $1 billion.
Wow.
And there's 200 million of debt, so it's worth 800 million.
Wow.
So I said, why is it trading at 16 million? He said, it's Turkey, everything's cheap. So at that time, the currency is so unstable, everything's unstable, everyone's exiting. So I meet the business founders. They seem perfectly smart, honorable people to me. I went and visited the warehouses. They're beautiful. They look awesome, great. And I went through exactly what he said, where it was very clear the business was worth 800 million. So then I thought, how much stock can I get? This thing probably trades by appointment or whatever. But Turkey is a market of gamblers. They buy at 10 o'clock, they sell at 3 o'clock, and they want to make 10%. That's how they work. And trading volumes are extremely high because everyone's in and out all the time. So for less than $9 million, I got 1/3 of the company.
Wow.
And now we fast forward 6 years. The market cap is about $800 million. The liquidation value of that business now is around $2.5 billion. It could even be $3 billion.
Wow.
Okay, so and it turned out, which I didn't know at the time, they're incredibly gifted capital allocators running this business, which I just thought I was buying a cheap asset. I was not buying a cheap asset. I was buying a cheap compounding machine.
Wow.
And I haven't seen them make any mistakes. They've redeployed capital at amazing pace. And the thing is that we are not going to sell that business. And we're going to own, it's a family business. Every year when I meet them on the Bosphorus and we have grilled bluefish, which is very good. I tell them, look, you guys control the company. I have no board position. I have no interest in telling you guys what to do. I just like to come here once a year, pat you on the back for a job well done, and then go on my way for another year and keep doing what you're doing. Warm regards. Okay. And that's it. So we just sit there. And so basically what we want to do with investing is we want to invest when it hits us in the head with like a 2x4, when nothing makes sense. Don't ever invest when it makes sense. Invest when it doesn't make sense. Okay, so the currency was very unstable in Turkey. In fact, it's decimated since I invested. But a warehouse is land and steel and concrete and paint. All of these are inflation indexed. So even though Turkey's currency has gone berserk in the last 6 years since we've owned it, in dollars, we've had a home run because we were buying a ridiculously cheap asset, and we got these great capital allocators sitting on this cheap asset. And we don't have to do this too many times. So basically, my job is hunting for anomalies, looking for things that make no sense, and paying zero interest to the Mag 7 or NVIDIA or Google or Apple or Microsoft or whatever. Zero interest. The whole world is kind of honed in on that. So how are you going to get mispricing? You're going to only get euphoric pricing.
Right.
In the year 2000, Cisco Systems was all the rage. It was the dominant company controlling infrastructure in the internet. And the internet was growing like crazy. And things got very euphoric. Cisco System was one of three businesses, one of the three most valuable businesses in the planet. Microsoft, Cisco Systems, and GE. These were the three most valuable companies, all around 600 billion market cap. We know what happened to GE. Taken out back and shot. Okay. And Microsoft went from 600 billion market cap to 200 billion market cap in the next few years. It was very overvalued. Cisco Systems business has grown a lot. It never saw that market cap again. So it's been 25 years since the year 2000. Their business is many-fold bigger than what it was. And their market cap is below where it was. Because it was euphoric. And so we don't want to invest into euphoria. We want to invest in things that are hated and unloved. Deeply hated and unloved.
I love that.
So that's what we do.
Yeah. It's not sexy until it is, until you get a turn $9 million investment into hundreds of millions of dollars. No one's going to argue that. I have two questions for you. And I know we're kind of getting near the end of the show here, so I want to respect your time. Number one, I'm going to Istanbul in 5 weeks. So where can I get really good bluefish?
Okay.
So that's my first question, and then I'll go to my second question. So where's the good bluefish for me to get on the Bosphorus?
Well, I'll have to email you because I cannot remember the names.
Okay.
But I'll send you the names of the places. Yeah. I mean,
right.
I think Istanbul, it's not just the bluefish. I think Istanbul, the desserts are amazing.
Yeah.
Kebabs are amazing. I mean, it's one of my favorite cities.
Yeah.
And because, architecturally, it's so incredible. People are wonderful. And yeah, the food is incredible.
Epic.
Yeah.
I went 27 years ago when I was 20 for 5 days. I spent 5 days there. I've never been back, and I'm taking my family on an 8-week trip to Europe and Africa in about 12 days. So I'm excited for that.
There's a neighborhood in Istanbul called Karakoy.
Okay.
Karakoy is kind of like it used to be a warehouse district, but it's now gentrified.
Okay.
It's right on the water. And I mean, just go into any packed restaurant there. It's just so good.
All
It's
right.
incredible.
I'll take you up on that. I'm doing that. My second question was, when you start thinking about, like, obviously you had a huge interest and a knack for investing. For younger investors that want to like follow in your footsteps, what would be your best piece of advice for them?
Well, I think that Buffett and Munger have left us a huge body of work. So my advice to them would be to read all the Berkshire annual reports, all the Berkshire annual meetings are archived on buffett.cnbc.com from 94 till now. I would listen to all of them. Now it's 5 or 6 hours each, and you got like some more than 30 years of. So you got like something like 200 hours of dense. I've listened to them all 3 times.
Wow.
And I still learn new things from them. But I would basically go all in on everything I can learn from them. And then when you feel like you've got the philosophy and you love to hunt for bargains, then you start looking in the nooks and crannies that people are not interested in.
Love that. Thank you. I appreciate the feedback on that. So I know we're at the end of the show here. 2 quick things. Number one, I know anyone that wants to maybe learn more about your work. I don't know if are you even taking investors? I know that you have a publicly traded vehicle. Is that correct?
Yeah, we have a mutual fund, and but there's a lot of rules and regulations about what I can and cannot say on a show like this.
Sure, gotcha.
But yeah, I'm not doing this to drive assets and any of that. I mean, I would just say, just Google me and you can take it from there.
Got it. Okay, cool. So we'll make sure we'll put some information for folks that want to learn more about Mohnish and his work. You're like the world's most fascinating man, right? Like I'm telling you, when I read your story in William's book, I was like, oh my God, this is so cool. We didn't even talk about the philanthropy work you're doing, but you are doing some really cool work, and I think people need to check it out. And I think it's a model for people living a really interesting life and really self-actualizing.
Well, my dad used to say that no one has left planet Earth with even a pin that they took with them. So they say he used to say that whatever we have is all going to be left right here.
Yeah.
We have no ability to take anything. He said, we come to this earth naked and we leave this earth naked. And so the game of life is leave the planet a better place than we found it, from nakedness to nakedness, make it a better place. And, large inheritances do more harm and good to your gene pool. So people don't think about it, and they think about, passing on things. So my kids they're fine. They won't be wanting for anything. But giving it to the gene pool and just leaving it at that is very suboptimal. So there are better things you can do in this journey.
Yeah.
So you can take it with you.
Love it, man. Mohnish, thank you so much for coming on the show today. Really appreciate your time, your expertise, and your wisdom, and so much gratitude from here at the Greatness Machine.
It was a lot of fun, Darius. Thank you so much.
You guys, please share this. We as leaders are learners, so please share this to all of our friends out there that want to learn more about living a well-lived life and around investing specifically. Until next time, peace out. We love you.
You are listening to The Greatness Machine, and that's a wrap for today. Listen, if you love what you heard, subscribe to the show on whatever podcast platform that you're tuning in on so that you don't miss any of our future episodes. We have tons of great people coming on, and we're stoked to have you here to enjoy it with us. Leave us a review. Tell us what you love most about this particular episode. We love getting the reviews. We love to see what you guys love most. And if this particular episode, made you think of someone who's leveling up in their business and in their life, print screen, share it with them. Leaders are the best givers, and after all, we're all here to support and grow with each other. And in case you want to see some of the fun behind the scenes shots or some of the things that we're doing, I'm actually writing about this in my weekly newsletter. Go to www.therealdarius.com and subscribe to my newsletter. We're talking about fun things like business and life and mindfulness and cryptocurrencies and gosh, I don't even know, everything and anything, but it's tons of fun stuff I write about. I try to get it out on a weekly basis. You can subscribe at www.therealdarius.com. And with that said, look, thank you guys so much. I appreciate you. I love you. Peace. We're out of here. See you guys on the next one.
She's my lover.